Welcome back. The new Reserve Bank Governor Lesetja Kganyago delivering his first monetary policy statement this afternoon. He's still taking questions. We are breaking out of that to get some analysis on the latest decision. The repo rate left unchanged by the MPC at 5.75%. Well, with me, Rob Price from ETM Analytics, Owen Como from Kunzi Investments. Gentlemen, thank you for joining us.
Thanks for having us.
All right, so we've seen the repo rate left unchanged, 5.75%. We'll talk about that just now. I want to take a look at this new governor. Okay, I want us to see what we can read with the Lesetja Kganyago's delivery this afternoon. His style, his posture. Let's go with you first, Nkomo.
Yeah, well, basically, I think he's a typical guy from Ekasi. He's a man from Alex. Speaks very fast and he knows his stuff. And I think that he basically expects everyone to have listened to what he's delivering. As he had some of the guys asking questions that he had already addressed, and he kind of got back to them, just like Tito Mboweni would. Says, you can't expect me to give you those answers, especially about what we're going to do next time. Just wait for the next meeting. Yeah. Otherwise, I think the difference between him and the previous governors is that he just was a little bit faster in terms of pace of delivery, but he was just reading from the same script, which may be a good thing.
Rob, we were talking off air that the script looked and sounded almost identical to what Jill Marcus would have written, but I suppose that's understandable because it comes from the committee, doesn't it?
Well, exactly. I think there were some rumours before the MPC that the governor might be looking to have a more hawkish stance, but that was very unlikely realistically. The governor is clearly, sticking to the script. He was part of the committee beforehand anyway, and we didn't really see too much change. There was a little bit of his personality that came out in the Q&A afterwards, as Owens alluded to, but I think if Jill Marcus was there today, she would have said very much the same thing.
All right, let's just talk about the decision itself. 5.75% kept unchanged. A lot of talk on the inflation outlook. Broadly balanced, that's the phrase he used. That's what he sees inflation doing. For 2015 next year, he's dropped the forecast to 5.3%. Owen, what do you make of his reasoning around inflation?
Yeah, I think it was nothing unexpected in our view in terms of most of the matrices they have to consider. The currency has come back from 11.36, it's back at 11.08. Yes, it remains volatile, but it looks to me like it's kind of found a balance around 11 rand to the US dollar, and it's actually strengthened against the other major trading currencies. And I also think that he mentioned more than twice the fact that the oil price has significantly declined from $115, and that's something that is very important when they make these when they are certain where they want to put the interest rate decisions, because it has a major impact on inflation should we see oil prices continue to increase and the currency continue to weaken. So definitely those two key points were balanced. And he mentioned a few other things that he's worried about, like the current account deficit and the need to control the debt to GDP ratio.
What do you make, Rob, of the inflation outlook? And he did say that this situation with food prices and the oil price, it looks, from what he says, to be around and persist for some time moderately.
Sure. I mean, I have two concerns with what we've seen from Kganyago today. The one being related to why inflation is dropping off so much lower, and that's hugely related to the global growth outlook. We've seen growth in the United Kingdom turn the corner, growth on a lower trajectory. Europe's not looking great. Japan's just slipped into recession, and by all accounts, the data we're getting out of China suggests that things are a lot weaker than the headline numbers suggest. So that all points to a much lower growth outlook for South Africa to react to globally, and that's very concerning. So yes, there might be a little bit of respite from the softer inflation outlook, but we've got to consider why that's taking place. And my other concern is that we've seen the SARB be quite almost reactionary to inflation. Yes, I completely agree with what Owen said. I mean, clearly the inflation outlook has moderated, but we've got to be considering the broader monetary environment that the SARB's dealing with, and the rand's still a significant risk going into next year. We're in a strengthening dollar environment, and both the SARB and the National Treasury haven't taken measures to protect the value of the rand. They continue to talk about protecting the value of the rand, but they haven't done it. They haven't really done it. They've hiked rates marginally over the last couple of quarters. But we still see the rand particularly fragile. We're running negative real interest rates. We've got a current account deficit, a budget deficit. Those issues need to be tackled significantly, not just the margin. And going into next year, we could see the rand still under pressure, and that could impact the inflation outlook again.
Which brings us to this concept that's been thrown about this afternoon, interest rate normalization. First of all, just put us into perspective. He did receive a question from one of the journalists there on this concept and what exactly it is and what the objective is in terms of normalization. Owen, let's start with you. What do you understand by this?
Well, basically, I think there's this perception in the market that interest rates are being kept very low artificially.
Yep.
Why do we say it's artificial? It's because there's been a lot of money pumped into the global economies, for which reason inflation has been contained as well, in line with the interest rate levels where the US has got interest rates at about 0.25%, and in some areas in the Eurozone, interest rates are actually negative. So he's generally saying that that cannot be sustained over the long time, and it's possible that interest rates in the next coming maybe year or two will probably start to tick higher. But the one challenge that I think global Reserve Bank governors and personalities will have to deal with is the fact that as much as basic economics says that if you put money into the economy, you will see inflation increase, the opposite is happening. That is a big challenge in my view.
Yeah, you agree with that, Rob?
I do agree with that. I think the one difference I would have on that view is not that the market thinks that interest rates are being kept artificially low. They are being kept artificially low. The interest rate is the price mechanism of money in the economy, and the SARB controls that, and they decide where it goes. We're very pro-competition in the economy and all sorts of other price mechanisms. But when it comes to the interest rate, the cost of money, the SARB controls that. And yes, around the world, what we've seen is that reserve banks have tried to push interest rates lower in order to try and create a short-term boost in credit, which would help to support economic growth. Theoretically, that's how it works. And we've seen that in previous business cycles that has worked. But as the global economy in general and most governments have become increasingly indebted, and private households have also become indebted, their appetite to take on more credit is reduced. So that policy is pushing at a string. We're not seeing much result. And yes, we need to normalize interest rates towards some kind of normal level. Years ago we were sitting with interest rates above 10%, above 20%. About 10 years ago. So we have to ask ourselves the question: why are interest rates so much lower now? Is the risk in the economy that much lower now than it was back 10 years ago? I think not. I don't think the risk is any lower. In fact, it's probably higher. So if the market were to determine where these interest rates are, I guess that would be a lot higher, closer to 10, 15%, not down at 5.75%.
I want to get your thoughts on that exact point, Owen, when we come back. Let's take a break. More analysis coming up.